We just got updated first quarter GDP numbers and they came in lower than the first estimate. They came in at 1.3% growth compared to the 1.6% growth in the first estimate. This lower than expected GDP numbers for Q1 is the lowest GDP reading since the second quarter of 2022, where in my opinion is when the technical recession started back then. So right now, this brings us back to right now. Right now it shows that right now we currently might be entering a period of economic weakness. Obviously, we have to see. The GDP price index was also 3.1%. So inflation is still high. Could we be in a stagflationary environment? Possibly, with lower GDP growth and higher inflation, because right now inflation is higher than GDP growth, at least as of Q1. The only benefit here is that the Atlanta Fed GDP Now calculator for Q2 shows that we're about 3.5% growth for Q2. Let's hope that holds. If that's true, then the economy might continue to grow, and especially if it's higher than the inflation numbers, I think that'd be a good sign for Q2. But obviously, we have to see officially once the Q2 data is released. We're not there yet. Obviously, we're in the middle of Q2. And then I also wanted to talk a little bit about Salesforce. Their revenue miss. This was the first revenue miss for Salesforce since 2006, and they issued weak guidance. Could AI be hurting cloud companies and software as a service companies like Salesforce? Possibly, and there's some analysts that are saying that. I honestly don't think so, in my opinion. I think Salesforce is a beneficiary of AI. I think Salesforce is in a 1996 moment for AI with all the spend. And I think Salesforce will ultimately benefit from artificial intelligence. I wouldn't necessarily say it's a table pounder, but the fact that the shares are down 20% today, and the fact that Salesforce is down 15% so far in 2024, I think is pretty compelling, and it's on my watch list right now. I still think Salesforce will benefit from this AI revolution, and I don't think we should count them out. And I think today's reaction is an overreaction, in my opinion. And then one other thing why the markets are declining today, besides the lower GDP numbers and Salesforce's revenue misses, that investors are anxious about tomorrow's PCE, personal consumption expenditures index, inflation numbers. It's the Fed's preferred inflation gauge. So if those numbers come in as expected or cooler than expected, I think the market would do well, and bond yields might lower a little bit, which would be good. However, if the PCE inflation is hotter than expected and have a month-over-month reading of 0.4% or higher, then I think bond yields will rise, weighing on the stock market a little bit more. And the biggest thing right now is that we have to watch the 10-year bond yield. As long as the 10-year bond yield, as I said in my video yesterday, is below 5%, I think we're okay as far as the stock market. However, if the 10-year bond yield surpasses 5%, that might be a problem for the stock market. And obviously, we have to see what happens.